So, boring title, I know, and I haven't been here all day, so I don't know what all you've covered in previous presentations. I think my presentation might dovetail well into from Cameron's talk in terms of the evolution of the financing process for a company that wants to develop an oil and gas technology. So, there are various sources of financing. I'm sure you've heard about a lot of them here today. There's the government programs, there's private capital, there's public financing and foreign capital as well I want to talk to you, and that's one you may not have heard of, but is becoming increasingly important in this marketplace. Each one of these types of programs comes into play at a different stage in the development of your company, and I'm going to try and highlight the practical side of it in terms of what sources of capital you should be seeking out and how you seek them out in the course of developing your company. Now, I'm assuming at this stage you and a couple of buddies have got a great technology, you've got some initial IP protection, you want to issue a bunch of shares, you've got billions of dollars in your mind going forward, and you want to get started. So, the first types of program I suspect you're going to access are the government programs. The most popular is the Scientific Research and Experimental Development Tax Incentive Program, or the SHRED program. Was that talked about here today? Anyways? Okay. The good thing about the SHRED program is for Canadian-controlled private corporations. That's the CCP reference you see up there, which is the same definition for tax purposes, which means a corporation that is private, controlled by Canadians, gets a tremendous benefit under this program because what they get are refundable tax credit. That means the government gives you cash to help you fund your operations. As well, the SHRED credits are great because they encompass a wide range of expenses, and in some instances they can cover my costs, which is a good thing, particularly in relation to the protection of the IP. You can get credits for wages, materials, machinery, equipment, even some overhead and contract costs. The disadvantage is if you do have foreign investors, the one thing you might want to look at is trying to structure it in a way that continues your status as a CCPC, because otherwise you lose that 35% refundable tax credit. Another program that's quite popular and is used, and now I'll have to ask you again, the Industrial Research Assistance Program, or IRAP, the National Research Council. Was that talked about today? Okay. They provide grants or loans for eligible research and development expenses, and they support principally salary and contracting costs. The NRC program is designed specifically to exploit new technologies. The costs covered can include professional advice, again, legal, IP protection can be covered, research and development support, technology partnering, and IP transfers. They also have what they call an Industry Technology Advisors Program. There's about 350, I believe, across the country in different areas of expertise that you can access, and they usually engage them if you are accessing the financing program. Now I want to get into the sources of private capital that Cameron talked about, and there's a range of sources, and I'm going to talk about sort of how you access these sources, when you access them, and sort of the type of share structure you're going to look at, or capital structure that you're going to look at when you do that. Now, the first source, in most instances, and I'll have to say, I haven't seen many instances where this has not been the start. People go to friends and family. They're the ones that provide the initial seed capital to get the company incorporated, maybe do some initial research and development, maybe help in accessing the government sources of capital that you might be able to get to perfect your technology. Angels, of course, and when I speak of angels, I basically speak of high net worth individuals. I'm not speaking of the super angels or the large family funds, often with their own professional managers involved. I'm talking about the guys that have made a bit of money, are looking to invest in a breakthrough technology, take some risk, put it on the table. Then there's the venture capitalists. We've heard all about them. Mike's been in the game a long time. I've done a number of deals with Mike, and he does have a lot of experience, so what he told you today is probably pretty close to the truth. And then there's private equity and debt, and that's usually once you're at a further stage in development, and their demands and requirements usually go into more developed ventures. So the source of capital that you access will be dependent on your stage of development and will dictate the structure. So in the early stage, you're gonna go after friends, families, and angels. Don't try and go after a VC. Don't try and go after a PE fund. Don't try and go after a large family fund, because they're not going to be interested, quite frankly. As you develop, as your technology develops, you can add some employee participation. Usually you'll have an employee stock incentive plan or a stock purchase plan that allows you to give loans to your employees to participate in the equity of the company. And then you'll probably add some venture capital, and maybe one of these family-type large family funds might be interested as a co-investor if you get a lead venture capitalist. Once you're rocking and rolling, you're going to go after the larger venture capital firms in private equity and debt. Now, each time you raise equity or debt on a private basis, you need to qualify for exemptions under securities legislation. It's really called an exempt capital raise, and most often used at the early stages of the friends and family and accredited investor exemptions. So in private capital, when you get into the early stage, my advice to my clients, and certainly seeing this through experience, keep your share structure simple. You should also have a base level unanimous shareholders agreement. That's what USA stands for, governing the rights between the shareholders, plus have your IP protected. At the development stage, you could probably add some preferred shares, possibly convertible debt. I prefer equity over convertible debt. From a company's perspective, convertible debt helps the investor. He gets the best of both worlds. He can participate in the capital appreciation, and he also gets the return and preferred position of a creditor. At that time, when you get to that stage, you're going to have an investor level USA. It's going to contain a number of investor rights like drag-alongs, puts, possibly registration and prospectus filing rights, and the like. So you're going to be getting into some intensive legal work. That's where I make my money, and you can expect that. Growth capital, you're going to have a built-out capital structure with diverse equity and possibly a senior debt component with that. And each of the investors are going to want their specific investor rights. And at that point, you're into a fairly complex set of legal agreements. I want to speak a little bit about public financing. Often people are led down this path in the early stage of their development. It really depends on the sector. It's the most costly initially and on an ongoing basis. The agency fees are usually in the 5 to 7% range. And there's the ongoing compliance cost of getting audited financial statements and doing continuous disclosure documents like annual information forms and public company level information circulars. Most often for innovation companies, public financings are used as a source of exit, either an IPO or some other means of secondary offering to the public. I would recommend this type of financing for high growth oriented companies in a favored sector with ongoing need to access capital markets. Oil and gas companies are prime for this market because they need to constantly access the capital markets to continue to build their land base and the reserves. I'm not sure technology companies in the oil and gas space, though, are in that sector. I want to speak briefly about the CPC program. This is something that our firm does a lot of, and often it's the only alternative available to a company that reaches a particular stage that perhaps has been shunned by the venture capital community or the private equity community, but the entrepreneur firmly believes in his program, and he can get one of the smaller bankers to back him on one of these programs. The problem with this type of program is that there's a huge promote for the people that jump in at the early stage, and you tend to dilute your equity too soon. These are basically the minimum requirements. You can look this up on the AC website or talk to most lawyers in town understand the CPC program. I want to talk briefly about foreign capital. This is becoming increasingly a source of capital for Canadian companies, not just for the large oil sands companies that are taking foreign capital as minority positions in their companies, but there are a lot of other firms. I act for an Indian firm based in Bangalore that has been investing in Germany, California, and Canada, buying principally IP, but also buying distribution channels. They have a cheap product that they can sell into the marketplace, and they need access to the market. They usually make equity investments, or they're also entering into joint venture or development agreements. And this may be helpful for this group because they are keen to do business. And if you have a good program and a good business, you can access this capital actually quite readily. Actually, tomorrow I have an Indian investment bank we're meeting with 3 or 4 clients with. So there are significant tax, trade, and business immigration issues you have to take care of on this. Also, if it's not the United States, where we have some special tax rules under our tax treaty, there are withholding and distributions on capital repatriation that you have to take care of. In an Indian company investing in Canada, they will usually have, for example, a Singapore company to make that investment for a number of tax and capital repatriation reasons. So here's the legal perspective. This comes from my experience, having financed or worked and financed with many companies. Don't complicate your capital structure too early. There's lots of guys that are going to come in later, the venture capitalists with their preferred shares, the mezzanine debt financiers with their convertible debt, the private equity guys with all sorts of unique and wonderful instruments, warrants, and puts. Don't over-promote or under-promote your founders. When I say that, over-promote, don't issue a gazillion shares right out of the chute. Try and keep it a simple, straightforward capital structure. At the same time, don't beware of an A-B type structure or a structure that ensures that some semblance of control remains with the founders. You don't want to hound on it, but there's ways to structure your deal so that going forward you can maintain a semblance of control. The third, protect your IP early on. Don't be showing your IP to a bunch of people. Always have a CA, and if it's patentable, don't disclose it until you get the patent process going. Go with experience. Don't go with some people that are just in it for the first time. Find directors, advisors, and investors that have done your type of deal in your space before. Beware of veto rights and ongoing hooks into your business plan. Often investors and early stage investors try and bite into either your business structure, your capital structure, or your technology by getting hooks into your technology. Be wary of that and be very careful. There will be some, there's no question, they're going to want them to protect themselves, but be cautious with them. Final point, be diligent and communicate. And I say that principally with your investors. More often than not, most of the problems I've seen with companies going forward is that their management feels that once they've got the money, they can run with it. Most successful companies I've seen keep their investors up to date fairly regularly and are very diligent in doing that. And that's it. Thank you.